Yeah, we're pleased to say the performance of the MPS range has been strong over the 6-month period. If we take the period since September last year, all 5 risk level portfolios have outperformed their benchmarks. All portfolios also provided a positive absolute return, ranging from around about 1.5% to 1.9%. And this has been achieved during what has been a pretty testing market backdrop. Our overweight position in UK equities has been beneficial because the FTSE All-Share Index has outperformed the US market during that time, and actively managed UK strategies such as Artemis UK Select in particular have also achieved very strong returns. Other factors have included being underweight to duration in fixed income. That's been very beneficial, particularly for our portfolios at the lower end of the risk scale, given this recent sharp rise in bond yields that we've seen. Thematic equity exposure to healthcare has been a bit more negative. Companies in that sector have suffered in the period after Donald Trump's election. There have been some concerns about a less favourable policy environment, although some have staged a bit of a recovery during 2025. In other areas, our holdings of dedicated US value strategies, likes of Dodge and Cox, they've been a positive during this recent period of equity market volatility, and that has really seen growth sectors such as technology suffer the largest declines. And finally, I'd point to the contribution made by our holdings of structured return funds, such as Atlantic House. These funds were able to provide a positive return in all but the most extreme of market environments. One of our highest conviction approaches of the past number of years has been to position the MPS portfolios to be underweight to long duration bonds. So that's underweight to long duration bonds. Bonds with longer maturities, they carry what's known as greater interest rate risk. And their prices can be particularly volatile when the market's expectations for future interest rates shift. Now, our asset allocation committee guides that fixed interest duration within portfolios shouldn't exceed 6 years. And currently, MPS is positioned to have duration at around about 4.5 years. So this is shorter than average. And what this means is that during periods when bond yields are rising sharply, our portfolios, especially the ones at low and low to medium risk, where naturally your fixed income exposure is largest, they can avoid the worst of the capital losses. Short-dated bonds also provide a healthy income stream and they have low levels of volatility. And so at present, we don't feel that the yields that are available on longer-dated bonds are adequate compensation for the greater risk of sharp declines in price. And given the highly uncertain outlook with regards to interest rates and inflation here in the UK, we believe that this remains the most prudent approach to take. We remain pretty constructive on the outlook for equities. We have to be cognizant, of course, of the risks that are present in the market, but we've maintained equity exposures around about the middle of our guided ranges. What's key for us is ensuring that we have the correct balance between the equity styles of growth, core and value. And so what this means is that we can provide returns in more than one economic scenario, and that's absolutely crucial. We've seen the benefits of this approach demonstrated in recent weeks. The portfolio's value exposure within UK equities, that's helped to mitigate the losses made from US growth exposure in areas such as technology. And being up to weight in equities means that it's important that our non-equity positions can provide a good degree of downside protection in the event that we were to see a prolonged equity market sell-off. We're pretty defensively positioned in fixed income. We have greater exposures to short-dated corporate bonds and short-dated government bonds, and these have low correlation to global equities, but crucially they also provide a healthy and attractive yield. Perhaps the biggest risk for clients in a multi-asset portfolio such as MPS is when equities and bonds fall at the same time, and so mitigating this risk is one of our key priorities. Structured return funds also have an important part to play, given their ability to provide a defined return, and they also carry low correlations to equities and US government bonds in particular. We did rebalance the MPS range in early March. We opted to reduce European equity exposure and take some profits after a period of strong returns. We've been cognizant of the risks that exist, particularly around an aggressive US tariff policy. US tariff policy has also clouded the outlook for inflation, particularly in the US, and recent data suggested that the disinflationary trend may have stalled. Given this added uncertainty, we've taken the decision to reduce our exposure to US government bonds. Yeah, it's a very interesting topic, and we've long had some concerns about the levels of concentration risk in the US market, and those levels really have resulted from the extraordinary share price growth that we've seen of the largest technology stocks over around about the past 2 years. Now, momentum and the flows from passive investing have certainly played a significant role. And whilst these companies are undoubtedly high quality, it's still unclear whether they can continue to grow their earnings to the extent that will justify the current premium that their shares are trading on. Now, the release of DeepSeek's AI tool has also sparked concerns that AI is perhaps becoming commoditized. And potentially this means that profit margins for semiconductor companies such as Nvidia may be coming down. And that's why we saw a pretty sharp fall in the share price of Nvidia in the aftermath of that news surrounding DeepSeek. So whilst it's a bit too early to say whether that Magnificent Seven trade has run its course, the risks of being overweight if momentum quickly unwinds, we don't think they should be discounted. And it's for this reason that we utilise what's known as a core satellite approach within our US equity exposure. So what this does is it combines a position in a US index tracking fund alongside a dedicated US value fund and also a dedicated US smaller companies fund. Now, turning to smaller companies, US small cap underperformance of large caps has reached historically wide levels. And in the absence of a US recession, which is not our base case, we do anticipate that small caps are going to be able to make up some of this ground. Our alternative assets, they're there to provide returns and yields that don't always move in the same direction as stocks and bonds. That's very, very key. They're there to reduce overall risk and provide balance to our portfolios. The alternatives category also includes structured products, and they can offer defined returns and more predictable outcomes. Now, within the alternatives asset class, we have allocations to what's known as directional multi-asset and also uncorrelated assets fund. These funds can be expected to provide a degree of counterbalance to the more directional risk exposures that are found elsewhere within our asset allocation. And our alternative allocations are really crucial. They're a really crucial part of our asset allocation framework because they can provide a different expected capital return and yield mix to equities and bonds. And in doing so, what they do is they deliver that valuable diversification within portfolios. Looking at structured products, they have historically provided superior yields to bonds and can at times also offer clients a degree of predictability in terms of their expected return. Our base case is that inflation will continue to moderate, but it's not going to decline in a linear fashion, i.e. there are going to be speed bumps along the way. If we look at monetary policy is restrictive. Interest rates in the US are well above the Federal Reserve's own long-run assumption, which is around about 3%, and this we think should help to keep prices stable. Now, of course, there are always tail risks, and at the moment these include aggressive US tariff policies, increased global conflict. But equally on the other side, if Donald Trump were to deliver on his promise to end Russia's war on the Ukraine, it could potentially lead to the reintegration of Russian energy exports back into the global supply chain. Now, that might seem a little bit unpalatable, but that is certainly something that can play out. And if you add that to the unwinding of the COVID-era production curbs from other global energy producers, as well as increased US oil and gas production, this could collectively boost overall supply and push down on energy prices. And what that will do is help to dampen any renewed global inflation pressures. In acknowledgement that our central view might not play out, the MPS portfolios do hold positions in inflation-linked bond funds. And they also remain focused on shorter term bonds, which, as we've mentioned, are less affected by changes in the economy, interest rates and inflation. Yeah, so we saw a Republican clean sweep in last November's US presidential election, and that does have the potential to really materially shape the investment outlook. One example is the negative impact that a Trump administration is expected to have on decarbonisation initiatives, because the Trump administration is likely to prioritise hydrocarbon energy production over renewables. And as such, our Asset Allocation Committee chose to exit the decarbonisation theme during Q4 of last year, and subsequently this theme was also removed from the MPS portfolios. As we look a bit further forward, there is the risk of more consequences, some intended, some unintended, and of course we need to remain alert to those. Responding thoughtfully to these consequences, whilst remaining focused on our longer term investment objectives, really continues to be our main goal. In 2024, we stayed constructive on equities, which we continue to prefer over bonds, and we're sticking to that view as we look forward throughout the rest of 2025. We stick to our view that a US recession is unlikely, that global economic growth will continue more broadly, and that inflation pressures will continue to moderate. Now, at the same time, we have to keep conviction about what we want to own within equities. We've seen some evidence of a rotation out of mega cap tech and more towards small and mid-sized parts of the equity market. That emerged as a theme during the second half of 2024 in particular, and we think we're likely to see more of this in 2025. Within bonds, we don't see a reason currently to shift from our short duration focus within fixed income markets. If we look at bond yield maturity curves, they're still pretty flat. And in our view, investors are simply not being paid enough to take on that additional interest rate sensitivity. We've got a good balance, we think, between sovereign and corporate debt allocations, because in our view, the additional premium for taking on more speculative, higher risk corporate debt, that's not very attractive at the current time. So overall, our thinking behind this asset class is not only the expected returns on offer, but also that it should provide a counterbalance to the risks we take elsewhere within the portfolios.